Welcome to this video on corporate valuation, focusing on the bigger picture of this discipline. This video will cover the themes of valuation, common misconceptions, and various approaches, including intrinsic valuation, relative valuation, and the contingent claim approach. Is valuation a science where inputs guarantee the output, like in physics and mathematics? Or is it an art where a certain magic touch is necessary? Perhaps it is a craft. There are many misconceptions in valuation. For instance, the objective is not a search for a true value or to provide a precise estimated value, as all valuations are inherently biased. Simpler models are often better than complex quantitative ones. Good valuation is a blend of narrative and numbers. The numbers provide the data, but the story gives context and makes the valuation fascinating. Both must correlate and back up each other. Theme 4 explores the convergence of price and value. Price is driven by market mood and supply and demand, while value is driven by cash flows, growth rate, and discount rate. Whether they ever truly converge is uncertain. The efficient market hypothesis suggests that price incorporates all public information, meaning price equals value. However, real-life examples show markets often make mistakes in pricing assets, but are assumed to correct themselves over time. Intrinsic valuation focuses on the value of an asset based on its expected cash flows. Approaches include discounted cash flow, or DCF, and the dividend discount model, or DDM. Key factors include the discount rate, cash flows, and the risk in those cash flows. DCF advantages include supporting business fundamentals and helping investors determine if an asset is undervalued or overvalued. However, it is time-consuming and relies on explicit, sometimes noisy inputs like beta, which is based on past history. This slide illustrates the concept of noisy beta in DCF models, showing historical beta calculations. Relative valuation, or pricing, values an asset based on comparable assets or transactions. Factors affecting this include the price of comparable assets, necessary adjustments, standardized measures, and the difficulty of finding true comparable assets in some regions. Advantages of relative valuation include ease of justification and fewer explicit variables. Disadvantages include the risk of buying overvalued stock and the assumption that the market is correct in aggregate, which can lead to bubbles. For some assets, like cryptocurrency and collectibles, only pricing is applicable, not valuation. Asset-based valuation values a business by valuing its assets, rather than focusing on cash flow or relative valuation. Methods include fair value, liquidation value, book value, replacement cost method, and sum of the parts valuation. Contingent claims, or real options, value an asset based on the happening of an event, often using the Black-Scholes model. Features include payoffs contingent upon an event, discretion of the buyer, and a fixed contract life. The advantages of contingent claims include the ability to value assets that might otherwise be unvalued, such as equity in distressed firms or small biotech companies, and providing a fresh perspective on value drivers, like risk or variability. A disadvantage of contingent claims is the difficulty in obtaining the necessary values to plug into the formulas. There is also a danger of double counting when adding option value to the firm's value. Thank you for watching this video on corporate valuation.